Cashflow Chronicles. As always, we're here with Hot Kris, the Desi God, Kris Patel.
Man, you gotta stop calling me a god, bro. It's getting like I'm feeling too good about myself these days. I need a little bit of humility.
The picks have been too hot. The picks have been
It's
too
like
hot. You're like,
Lord
man,
Krishna is here to bless you
this
with
man
good
might be
stock
onto
picks.
something. But yeah, Kris poked at me today. Obviously, CPI came out this morning, so that's probably going to be a big topic of discussion. And that the website actually gives you a lot more information than I think a lot of people look into. I think they just look at the main headline number, and with that, I think that they might not truly dig into it a little bit more. But we have, everything that we probably need to look up. So, Kris, you wanted to kind of chit chat about it. I have up whatever you need. Just tell me what you want me to click on, and I'll be more than happy to go ahead and do it.
So one of the things is when you're looking at inflation numbers, especially in terms of what the Fed is trying to do, people often they look at headline and they're like, oh my God, the market's going to move in a certain direction because the Fed's target is not reached for X, Y, and Z. And the thing is, headline, CPI is made up of a lot of different categories, but some of the categories are kind of volatile. So if you look at how energy prices can be impacted by geopolitical issues all the time. So if you look at historically what the average inflation rate is going back almost like 20 years, you can see that it's been pretty steady. But if you look at the prices for energy, you see these peaks and valleys that keep coming up back and forth, back and forth. So that's why one of the things that the Federal Reserve, when they make policy decisions, they completely ignore energy costs. So what does that mean? That means the price of oil and natural gas tend to be overlooked, as a metric for where we're headed in terms of inflation. So if you look at the 2% target, it pretty much excludes out the energy component, right? So a lot of times people, when they look at just headline CPI, they get a little, like flustered by the number, like, oh my God, it's going back up. The truth is, with energy prices going up and down, it can really impact headline. What we really want to look at is core inflation, because core inflation is what's going to drive policy decisions. So core inflation, if you look at it today, was actually not bad. Like it was actually trending in the right direction, and that trend line hasn't been broken yet. So if you look at all items less food and energy, so you see that right below electricity, that's what we actually, that's what we actually want to see. So if you just go back to, let's say, all time, get rid of that and just do that. Perfect. There we go. So you can see here that trend line isn't broken. It's still on its way down, right? That's what we're looking for. We want to see the price of core inflation keep dropping. So if there was a change to this part and we were going, let's say we had a bounce the other direction, then we could safely say that we're going to have interest rates higher for longer. But this is clearly showing that the trend is in the right direction. And, overall, we're in a good place. Core inflation is not accelerating. It's not re-accelerating. All we're seeing is the lagging impacts of the higher energy prices get put in for September. But then there's also one other thing that's super, super sticky that's happening right now is shelter. So if you just put in shelter and get rid of the food and energy prices, right? Shelter, for the most part, is still on the decline, but it actually it's still relatively high compared to what we've been used to historically. So if you look at shelter inflation, it usually trends between, about 2 and 4%. So usually the good years, you'll have like a, in excess of like 3% year over year growth, maybe 2.5%. That's why like real estate is a good investment, because you get at least a 3% compounding rate of return every year if you hold real estate. Now, thanks to a lot of the structural changes that we've had, thanks to low interest rates, there was a huge demand spike in people buying homes from COVID lows, and the year after the COVID lows, all the way to about April, May of this year. So shelter costs just went through the roof. Now, there's a couple of reasons why shelter costs went up so much. And there's also a couple of reasons why this will actually be one of the biggest tumbles going into 2024 and possibly 2025. And let me just, can you pull up my Patreon on your thing? Because I put the data points today that kind of highlight like where we're going in terms of inflation. So
I think I'm
yeah.
logged in. Yeah. All right, it's logging in right now.
Okay, perfect. Yeah, so I brought up a lot of these charts on the Patreon just to show people like what's actually happening on the ground, and then based on that, we can kind of at least get some decent formulation of what's going to happen going forward. So. But a lot of things have been going down, and we're definitely in a disinflationary cycle. Do I think we're going to get one more rate increase? Maybe, just to be on the safe side. The Fed may say, listen, we don't want to give the market a perception that the battle is done and over with. But at the same time, they're also not going to be as hawkish as they were in the past, where they were just like, we're going to crush inflation. So I think they're going to be very neutral in November's meeting. They might even keep a pause, actually. If they pause, we're going to have a pretty good year, like a pretty good rest of the year, So, yeah.
So this is what you're referring to here. And I guess this is just housing activity.
Yeah.
You're not saying at the moment that, and I know we talked about this a little bit last night. You're not saying that housing prices is going to fall off a cliff. I think what people might be thinking about when we say, I didn't share this screen. That's my fault.
Okay. No problem.
When people are thinking about maybe what we're talking about, that's my fault for not sharing this, because I thought I was sharing this graphic here. But the shelter doesn't mean that, if it continues to decrease as it kind of has, like we were just kind of showing on the previous chart, doesn't mean that housing is going to say fall through the roof. It just means it's going to increase at a slower pace than it was, probably back to normalized rate. So some places, like Kris was talking about last night, places that saw large influxes of people where prices went up massively, because people were moving to those places during pandemic times, they were able to work from home and all that sort of stuff. Those areas might see a max exodus of people, or they just might not have as much demand as they once were. And so they might actually see declines, but I'd say the majority of places have held up pretty well. And going from an 8% year over year to a 6% year over year still means that the prices are going up. Just might not mean they're going up at the exacerbated rate at which they were in 2021. I saw some areas, some homes that were bought in 2020, 2021, now trying to relist for 25, 30% more than they were, especially some vacation rentals that I've been looking at. And so that's just a huge piece of inflation.
If you look at this data point, you can see that core goods inflation is pretty much dead. It's flat year over year. So that's in like beyond disinflation. That's like deflation technically, because it's not growing at all. Like it's gone zero. So core goods is completely dead, right? If you look at core services and strip out shelter, look at the level of shrink that's gone under. So that is like literally, I think almost like just one of the slowest growing points that we've had in a very long time, in the last year and a half. So that's a very important point to make. That blue that's right there, that's something to look at also. So you can see here the largest component of CPI right now is the shelter part. That's really killing us. Even food, if you look at the price of food, has gone down significantly compared to what it was last year. And I think that trend might actually be happening even more, considering, we can talk about the Ozempic and the Eli Lilly and Novo Nordisk thing, because that is an active market that's being formed right now. So a lot of like diabetes care companies and a lot of fast food companies, they all took a dump over the last couple of weeks, man. So it's definitely something we'll talk about at the back end of the pod. But
now,
if you could,
what particular sectors do you see entering deflation?
So number one is probably going to be food. Right? Food is one of those things that went up significantly over the last couple of years, primarily driven by natural gas prices, which went into fertilizer, and then fertilizer translated into higher cost of production, and then higher cost of production ended up translating into, issues with that. But what I think is going to happen in the next couple of years is then the amount of people that are losing, that are taking these GLP-1s is going to increase significantly. And the thing is, they're going to be consuming less. And if they consume less, but our production is still relatively high, that means that we might actually see the cost of food come down beyond a certain point, so that's one thing. There's one more thing, if you could pull that back up, because I just wanted to show one more thing with the housing. Scroll down.
And I see that as a pretty common theme that people are talking about with the Ozempic and the GLP-1s. And I think that could be a play, right? Where people might look at it, and not to say, I mean, the problem is I think like 5% of people right now have in the United States are kind of on some sort of GLP sort of drug, which obviously is a large mass going from 0 to 5%. But I'm not sure at what point it opens up to the masses of people that don't necessarily have pre-diabetes conditions and stuff of the like. But at what point do you say, oh, a 25% sell off in Pepsi, or a 50% sell off on Hershey's candy, or all some of these other ones that have been absolutely decimated due to this exact sort of theory? At what point is that overdone, and do you buy back in, knowing that eventually they're going to find their footing and either reduce headcount or just reduce the amount of costs associated with everything to kind of make it, a profitable business again? And I think that's an opportunity to look at, 12 months down the road potentially.
I think we're very early in the life cycle of these GLP-1 medications. Like, there's still a large portion of the United States that, believe it or not, the insurance companies are now, and I have some data to actually show that the insurance companies are going to be pushing this, because if you look at the total cost on a lifetime basis of like insurance coverage of someone who has obesity as a precondition, the total cost of maintaining that person's health over a long period of time is way in excess of giving them a medication that helps them, lose the weight and even keep the weight off. As long as some of the costs are shared with the consumer can benefit from lower input, like food costs. It's like a one-off scenario. And so what ends up happening is more insurance companies, they're likely to cover this over the next 2-3 years. I'm sure that they'll incorporate some what is that thing called, like behavioral and lifestyle modification requirements in it also. But just the effectiveness of these drugs is just on another level, man. So there, like I said, I think like I said, when I was on the cruise with my wife and we were just walking around, I was just looking around. I was like, man, that person's a candidate for Manjaro. That person's a candidate for Manjaro. That person's a candidate for Manjaro. And I realized that while walking, it was like 70 to 80% of the people that were there were probably likely candidates for one of these obesity medications. And most people are, I don't want to say it's a quick fix, but it's literally just you take one shot a week and that's it. And the ease of access is going to be probably the biggest driver in the future. So I think this is one of those times where we might actually see a revolutionary change in healthcare. And at the same time, if you look at the total world population that's currently in one of the stages in a stage of obesity, it's mind-boggling, the total numbers. That's why Eli Lilly's worth close to almost $600 billion right now, because everyone is projecting out these really lofty gains. Let me see 1 second. Let me see how much Eli Lilly is worth. Eli Lilly's worth right now $579 billion, and they're just on a tear. Same thing with Novo Nordisk. Novo Nordisk right now is trading at about 340 billion. And that's after their split. If you look at their stock price, like, let me just show you. I understand. Let me just, this is Novo Nordisk, one of the companies that makes the medication Ozempic or Wegovy for the weight loss portion. Look at this. 2018, $20. Right now, they 5x. They're at $100 a share. Their PE ratio is at around a 47, but their growth is just on another level of crazy. Look at this. This is a pharmaceutical company generating 50% year-over-year compounded net income growth.
Yeah,
the margins
that once or twice
climbing.
more, then that PE ratio goes back down to the $15-$20 per earnings range.
Absolutely. So, this was a really good opportunity. I posted it on Twitter last year when I first saw the GLP-1s were starting to, really become a big a big um a big portion of the conversation, and yeah, they've done phenomenally well. So
Alex, thank you
so
for becoming a member, my friend. I appreciate that. That means a lot to me and
yeah.
Chris.
Thanks, Alex. Yeah.
Yeah, the thought process that somebody mentioned Accelera as well. I think that's
Mhm.
a company you talked about probably about a month ago. They're saying that it's basically trading at a cash value because I think they still have about $1 billion in cash on hand, if I remember
Yeah.
correctly.
Yeah.
Is that you still have that in your set it and forget it portfolio?
Yep. Yep. That is a 10-year hold, man. Like the technology that they have is proven, the management is good. Majority of the people that are there, they're scientists that are really doing hardcore research. But the thing is they're going to take it's going to take time for them to develop the candidates in partnerships with these larger pharmaceutical companies in order to
Right.
get them to the market. So it's almost like it's like being a recruiter for like for a D1 high school team, right? Not I mean D1 high school athlete that will eventually go to college and then go to the NFL. So right now we're investing in this company at the stage that it's still in its like high school phase. So
Uh,
I would not be buying or selling options on this. This is just purely buy the stock, hold the stock very long term. Now, the part that really confuses me, if you really look at it, look at the analyst price targets. None of them have really modified it that much since its IPO.
hmm.
And by the way, this is not a DPO. This is an IPO. So a lot of this stuff was vetted. They have more cash on the balance sheet than their book value. They have no debt, which is
Yeah,
another nice
I think
part.
that this one I need to do a little bit more looking at as well because I know a lot of the work and revenue that they had a lot of the work and revenue they had kind of coming in was associated with a lot of the COVID vaccinations. And since a lot of that has fallen off to an
Yeah.
extent, they're kind of just waiting for several of these drugs. And so to kind of come into fruition, the licensing of it and
Hmm.
with that, I think that that'll be, but yeah, like you said, with respect to the options piece, these guys don't even have 2026 options. I was going to look
Yeah.
at potentially opening a spread, but the liquidity of it is so few and far between that it just doesn't even
Yeah.
make sense
Yeah.
to do that.
It's better just to buy the stock. It's such a low valuation. Like I said, I would just dollar cost average into it, throw a few bucks here and there. And the prospect of this 20xing is pretty high, in my opinion, especially now that it's down to $1 billion market cap, where they could be headed. So their entire business model is set up so that they are they technically are a CRO, which is a contracted research organization where they hire scientists, they do the research, then they hand back the research to the pharmaceutical companies who do the clinical trials and then do the marketing and sell the drug. And then these guys in lieu of, in lieu of high contract fees, they get part equity in the drug. So basically what happens is if they research a drug on behalf of Pfizer or on behalf of Eli Lilly, because that's one of their partners. They have a lot of great partners, by the way. So if they partner with that partner and the drug goes to market and makes $1 billion a year, these guys get a piece of that as income that they don't have to do any manufacturing. They don't have to do any additional work on. And so it's kind of like being an agent for like a basketball person. So as long as that agent recognizes that this person can go to the NFL, to the NBA or NFL, after they get to the NBA, this guy makes the money,
Right.
So,
I do have a
yeah.
question for you though. So
Hmm.
getting back to the CPI piece,
Yeah.
the Fed now, I appreciate you breaking it down for me because like I've kind of done research on my own, but having you and walking through it with you, slightly makes a little bit more sense comparatively because I was always kind of curious, like, what's the real difference between CPI, core CPI? When we hear the Fed being very, very stern about the 2% number, is
Hmm.
that with respect to core CPI or is that regular CPI or is it they haven't really specified which one, and so it could be interpreted as one or the other. And the reason why I ask is because if we go through this series of say big moves up and down with energy, it could be something where you kind of have CPI, core CPI down at 4%, and then you have regular CPI kind of exploding. I don't know why it's not letting me choose all items here, but you kind of have all CPI kind of just exploding at there we go.
The one that they're really looking at
number.
is all items less food and energy. Like that's the one that really gets them. So if you look at that like if you click off of that, look at historically how that's been. So just get rid of the all items on your thing. Okay. So you look at it going from 2001 all the way to now. So you see how it's relatively stayed flat at that 2%. That's the target that they're trying to get to. That's the one that we really want to see. So the question now is, how fast are we going to get there? One of the challenges with the Fed is that, the longer inflation stays high, the more the expectations get built in, and the more that the consumer ends up expecting that higher rate of interest. And then what ends up happening is now you have unions and you have all these employees and negotiators negotiating for higher rates of employee growth, like salary growth. So if now employers say, oh, you know what, because inflation is high and it's sticky, we'll guarantee a 4% raise every year for the next 5 years, wage inflation will take a hold. And now what's going to happen is that is going to end up translating into the general economy, because everyone is now going to be spending more money, which means
everyone has more disposable income, and then it's
right,
which can be good if you need to kickstart an economy that's already down, right? That's kind of like the cutting tax sort of piece. But if everything just, everyone's getting paid more, then that means, it's not like you have tax breaks. It's like the value of the dollar that's kind of went down, right? And I was just having this conversation with my buddies, specifically going back to like restaurants and McDonald's and stuff like that. He's just like, I just don't understand how a McChicken is $3.20. It used to be $1. Like, and it's part of that. Well, everyone thinks that the $15 minimum wage, and I don't want to get into the politics of that and stuff like that, but you have people going basically doubling the minimum wage. It's like, well, now everything that used to be $1 technically now should be $2, just based on the fact that the bottom floor prices of what it costs for an hour's worth of work at a minimum just went from $7.50 to $15. And I don't think people think about it that way. The people that are at the bottom of the totem pole just looked like, hey, we just got a 100% raise. But that means my work is now less valuable. Your work is now less valuable, unless we all get a 100% raise, but we didn't, right? Like,
yeah.
And I think a lot of people, exactly what you're talking about at our company, we were arguing about what's the appropriate amount for a raise for us in 2021, 2022, because we were seeing numbers like 6%, 8%, 9% coming out. And you saw certain companies, some of them were paying up to 10%, some of them were paying, 8% across the board in terms of raises. So everyone kind of has their opinion. When you have these sorts of big moves in one way or the other, that people are expecting 4%, that's not enough, right? Like I saw that everything else is up. Eggs were up at the time we got our raises last year. Is like eggs were up, 6 months ago. Eggs were up, $8, $9 for a dozen. Everyone was taking out second mortgages to buy them, right? So, you have these people that were kind of getting screwed on both ends. Obviously, the price of everything was going up, and then here they are, not getting the appropriate raises that they thought they deserved. But then they were also seeing other people get raises that they thought was prudent to do. But anyway,
dude, I haven't got a raise since 2001 when I left my last job and joined my current position, because like they're doing like negotiating with because I work. It's a union position, so
you meant 2021, right?
Yeah, the end of 2021. So
okay, I thought you said 2001. I was just like,
no.
I was like, one, I was like, I don't think you've been working that long, and then two,
yeah, no, my so the union is doing its negotiating with their with our employer, and the thing is, the employers are kind of like, we'll do like 3%. My union's like, look, inflation's been like 4.5%, 5% for the last 3 years. Like we haven't got a raise. Like we need to bump up that money, get us more money. So right now there's a like a push and pull, because if you think about it, if you give raises that are at inflation, you're not really like giving a raise. All you're doing is just helping people maintain their cost of living, right?
Mm.
So the other thing is like the organization I'm part of, sometimes they don't even have like performance bonuses or performance raises. So it's like, like, so basically you just want me to be like a wagey for the rest of my life and
Mm.
just accept the money that you're giving without any sort of additional, additional compensation. So sometimes it feels like, okay, what are you going to do? And this is why you always need to figure out from an investing standpoint how to make more money from some of the money that you have. So this way you're not beholden to the employer for the rest of your life. Like it would suck to have to work for somebody and basically just subside for the rest of your life. And that's what investing does. If you invest the correct way, it gives you that financial freedom to not have to like worry about that next raise, because you can give
Mhm.
yourself a raise, right?
And you
That's
don't
what
have
we
to
want
bend
to
your
do.
morals too. Like
Yeah.
I think some people, they get caught in this trap of, oh my God, I have somebody that I have to take care of, or I just bought this house, and they get in this situation where they're like, well, I really need this job. Like I really need to be able to
Yeah.
pay for the things that I've kind of locked myself into. And so if that's the case, you might end up having to bend your morals a little bit. And the problem with that is not the first time you bend your morals. The problem is you bend your morals the first time, and then over time, you slowly bend more and more and more. And you don't go, you step over the line once, and next thing you know, you step over the line a few times that it ends up being 50 yards away. And you're like, holy shit, how did I get here? And I think a
Yeah.
lot of people end up in that sort of situation where, and you hear about these things about different companies and the scandals that people go through. And a lot of it ends up with that, where people end up having to bend their morals just a little bit to be able to make ends meet. And next thing you know, they're doing ridiculous, illicit stuff that they never
Yeah.
thought they would see themselves doing just to be able to, and they had no idea.
It's funny. I'll cross that line and sell my feet pics. Interesting. Yeah, so right now inflation is starting to come down. So we are starting to see disinflation. So disinflation narrative is not broken. Um yeah. Oh, there's one other chart that I wanted to show from that screen if you could pull it up.
Yeah.
Since shelter is the highest, like pretty much is keeping up with like the highest portion of CPI. There's a good explanation to this. During COVID, you can see the inventory levels. They were relatively go up just a little bit for a second.
Was it this one?
So yeah,
Active
the
listings.
inventory.
Yeah.
Yeah, so the active listing of homes in the United States, they usually hovered between 1.5 million to about 1.2 million, give or take. The seasonality between people moving and buying, and so usually what happens is people will list their homes in the springtime, sell them in the summer, and then they'll pull back during the middle of the year. That trend really broke down during COVID. But you can see post COVID, there is now inventory starting to come on the market. And if you go one slide further down, you can see that the last year's seasonal dip, right, is a lot lower than this year's seasonal dip. So that means that inventory is starting to come back on the market. And I think this trend will keep going forward until we see a more like stable and normalized inventory levels about 1.2 to 1.5 million. Now, how fast is that going to happen? I have no clue. My
Mm.
best guess is it's going to take maybe 5 years to get there. This chart is very interesting also because you can see the cost to rent has materially gone up. But if you look at the cost to buy, thanks to the higher rates of interest rates, they've gone up even further. So right now, prices on homes are super high, and at the same time, the interest rates are super high. So not a good combination, because that means that affordability for homes is just really bad. And so all of this stuff translates into higher CPI, especially for shelter. And it keeps the Fed like, oh my God, what are we going to do? What are we going to do? But the thing is, it's the rate at which they grew interest rates that's causing a lot of stress right now in the housing market. Because why would you, like, let's say you're an existing homeowner and you have a
Mhm.
3% mortgage or a 4% mortgage, right? Why would you sell that home that you have a 3% mortgage on to buy another home at an 8% interest rate. You are not going to want to double your interest rate just to move to a different location. So, a lot of people are holding back inventory. They're saying, yeah, you know what? I'm just going to hold, I'm just going to keep living here. I don't need to buy another house and pay double my current mortgage. And so the minute the Fed starts to lower interest rates, I think there's going to be different cohorts of people starting to put their homes on the market. And I think that's what will cause the inventory to kind of like make its way back to a normalized level. And I think that is the key to deflation for the next or disinflation for the next couple of years. So as more homes come on the market, the relative selling prices will start to moderate a little bit, and that moderation will lead to just a more stable housing market. So if you go a little bit further down, I think there's just one more slide right there, which is the total amount of units under construction. So you can see post COVID, because relatively the price of homes has really gone up really a lot of the home builders, they're taking advantage of that. And so they started building homes like crazy. So if you look in Texas, man, you guys just have homes going up everywhere.
Yep, everywhere.
So the inventory of new homes under construction is pretty significant. But what's even more significant is the amount of housing units that are primarily built for the rental market. So, whether this one is looking at specifically for buildings with like 5 or more units, it could be condos, could be co-ops, but mostly it's probably rental buildings. So it's almost like, those giant buildings that you see that have like the 100-unit rents or whatever. Those are just going crazy in terms of like the building. So they are at an all-time high. So this is how many are actually under construction right now. So once again, this is inventory that's going to be coming on the market in the future, right? So as these homes or these housing units come on, that takes away the share of people looking to buy a home and instead just, rent homes out. So that's now the question that I have here, and this is the thing that's kind of like throwing my math off, is that we've had almost 3 million immigrants or legal immigrants cross into the United States. They're going to need housing, right? If you take them into consideration, that is a large increase in active people that are going to be searching for shelter, whether that be paid by the government or whether that's paid by, people congregating in one home and living, because that's what people do. That's what immigrants do, especially illegal immigrants. They congregate in one apartment and there'll be like 8 people to an apartment.
Yeah.
So that's just how
I've seen it.
Yeah, that's just how it works. But they will also be a shadow inventory that's going to be like, a shadow demand that's going to make its way. So I think that will prevent a giant crash in the housing market. So we'll see what happens,
So I do have a question. And to iterate your point with respect to the immigrants, I think a lot of the migrants are being stored up in hotels in New York and Chicago and stuff of the like. And so that's putting the supply and demand of that, in jeopardy as well, because now you can't go to New York because some of these, high-end hotels are unfortunately booked up because they're housing some of these folks. And so, it's a crisis altogether on its own. But my question to you, you kind of see the cyclical nature of on the graph of what we're kind of looking at on the screen here, where the blue is housing costs associated with I assume a mortgage and just how much it costs to own a home, and then you have red, which is obviously the rent. The red is very steady, right? Like you can see that goes up anywhere between 2 to 5% almost a year, where there really only one flat line was after the 2008 financial crisis.
And that was very small. Yeah.
So my question is like, the thing about buying a home is that, to an extent, you were able to lock in a price, right? So for example, if you were buying homes in 2015, 2016, 2017, 2018, you were buying them in the, let's just say, $1,200 to $1,400 a month rent basically back then, And now, you're able to rent them out effectively for 1,800 to 2,000. So, you have a little bit of that wedge. So it's like
Mhm.
inflation can help you twofold when you're looking at some of this stuff, because as Kris kind of alluded to earlier, generally speaking, inflation for homes is anywhere between 2 to 3%. And with that, you think about it, you're not buying a house 100% most of the time. Some people buy cash. But
Mhm.
when you buy a house, let's just say with 20% down, you're leveraging that 3% inflation cost on the entire home by 5 times. And so technically the money that you gain out of that, now of course we're 86ing all the fees associated with sales and closing and stuff of
Yeah.
the like. But that 3% of your house, it went from 100,000 to 103,000 the course of a year. You only put $20,000 in. And so
Mhm.
that $20,000 is now worth $23,000 based off your equity. Let's just negate all the principal pay down in your mortgage and stuff of the like. But what you're
Yeah.
seeing is on your money, 20,000 to 23,000, it's a $3,000 gain on 20 grand. That's a 15x return. Sorry, not
Yeah.
15x, 15%. And
Yeah.
so that's where I think some of the money gets made. And if anybody's here looking at, say, real estate, and they're thinking, oh, Kris made the comment yesterday, which I get this sort of mindset, because it is a sleep well at night versus wealth accumulation question, and what works best for you. But for somebody like myself, it's like I'll always probably keep maybe a loan to value ratio of 50 to 65% on my properties, and use whatever excess money to be able to capture more and more ability to get more and more homes, because the more and more
Yeah.
homes you get, the more inflation you're probably going to be able to capture. And
Yeah.
then you have a 2 to 3x on whatever sort of equity you have in that home, and you can come back in a couple of years, take more equity out, and do whatever. But that also comes with risk, right? So you have to
Yeah.
make sure that you're analyzing, are you, because some people might let you take out 85% loan to value, and you're like, here you are sitting
Mm.
here fat, dumb, and happy. Then you get in a period where, let's just say, that area starts to degrade, or you're in a high interest rate environment, or who knows what, then you might not be able to access that cash, and you might be putting
Yeah.
yourself in a risk where you're now having to increase the amount of money that you have to pay on the mortgage every month. Because every time you refinance something, you have to recognize you're restarting at zero again in terms of your
Mhm.
loan time. You're privy to whatever the interest rates are at the time. And so it's not always a guarantee that you'll be able to do that. What Kris was referring to yesterday was, it's almost like a level of fuck you, where if you just own your home, you can literally just have that freedom, and you don't necessarily have to worry about, oh, I
Yeah.
need to build so much wealth. And you're not playing the game anymore. You won your game for yourself, right?
Yeah.
And that's all that matters sometimes. So you have to look in between all these different things. And the way I want to get back to, and I'm curious about your thought, I'm buying a house. I'm buying it with
Mhm.
the thought process that it's going to be a future rental property. Obviously, with the way the interest rates are right now, if I were to put it on the rent market, I would be losing money, probably 300, $400 a month, just by renting it out. But my thought
Mhm.
process is twofold. In the next 5 to 10 years, when I own this property, or not own it fully, but own it, through the bank, and rents continue to rise from the 1845 they are today to 2000 in a couple of years, to $2,200 in a couple of years, I'll eventually be able to make money on that property and
Yeah.
keep it cash flowing, and also potentially refinance if rates come down. So it's almost
Yeah.
like a twofold. It's like I own the asset now to an extent at 200 some dollars a square foot, relatively cheap compared to some of the places in the world, and
Mhm.
in the United States. And eventually that house will go sell for $300 a square foot, or $400. And a lot of that's going to be inflation, right? I
Yeah.
don't think that the area is going to appreciate that much. It's mostly just going to be the fact that it's inflation. But now I have the ability to rent that out in the future,
So for me,
and lock that in.
I, I ran that same calculation when I bought my condo in New York, because I could have rented something for about $1,000 at the time, like thousand, maybe $1,100, a one bedroom where where I was, and this is right after the great financial crisis, and a lot of my friends, they chose to go that route. I ended up choosing to buy my apartment, right? And they thought like, oh man, what are you doing? You're paying an addition, because at the time my mortgage, maintenance, and everything came out to be about $1,500. So they were like, man, what are you doing? Why are you spending this extra money? You could just get yourself a nice place for like 1,100. And I was like, nah, man, but one, I'm burning equity by buying this home, right? I mean, by renting, because I'm not getting any return from it. And at the same time, I'm not going to be able to leverage that loan into higher value in the future. And I grew up, like my family, we grew up renting forever. And it was probably one of the worst mistakes because we didn't build any generational wealth doing that. So I definitely said to myself, I'm not doing that again. So it was great. My maintenance went up, of course, but not like by a lot. And right
Mhm.
now, those same people are paying close to $2,500 a month. And my
Mm.
mortgage payment comes out to be about, mortgage and maintenance and everything comes out to be about between 1,700 and 1,800 for my property in New York. So now I'm the smart guy. They're the dumb ones. And not to mention, my property has appreciated almost 3x from when I bought it. Like I bought it and it was only like, I really did a good job negotiating the shit out of my thing. But I'm selling it this year and I'm selling it for about 3.5 times what I bought it for.
Mhm.
So not only did I get to live there for a long period of time in a really nice place, but at the same time I ended up now benefiting from the sale of it. And I wish I could keep it, but it's not feasible for me to keep it anymore and pay the rent, and I'm not living there, and I don't want to turn it into rental and deal with the headache of renting it out. the
Mm.
other the other thing is, like, eventually I'm going to buy a home here, and the goal that I have is probably just like sell my condo here in Atlanta, sell my condo in New York, and just buy a really nice little McMansion in the suburbs somewhere in
Mhm.
Atlanta. And boom, I'm no rent, no more. I mean, no rent, no mortgage. All I really have is just pay the maintenance, and I mean, not maintenance. Sorry, pay the for the
Taxes.
the maintenance and the taxes, and I'm good. So
Yeah, I mean, I'm curious. Like, so, I this wasn't a hit, by the way. I'm just curious because you've been talking about selling the New York condo for a while. Is it just you're
mhm.
just waiting for the right time? You know that you wouldn't have somewhere appropriate to put all that capital that you'd be getting back, so you're just
No,
kind of biding your time, or
there was a clause when I bought it, because what
yeah,
happened was this building was under construction during the great financial, like, literally they had put in the construction before the great financial crisis, and they were about to finish most of the building, right when the bottom fell out from the housing market. So what happened was demand had absolutely been crushed. So
right,
the developer at the time did not have the funds to cover the rest of the construction. So they actually turned to the state of New York and said, "Look, please help us out. We really want to finish this building. Please give us these loans." And so what happened was the developer got loans from New York State, and New York State at the time said one of the clauses that they had was they didn't want this to become like something where the rich could just profit off of everything. There's, yes, includes property taxes and HOA. They didn't want it to become something that people would speculate using, right? So in order to do that, what they said was all the people that would be buying from the sponsor of the building, they had to at a minimum stay there for a certain period of time without getting without having the building's underlying mortgage, because that's what happens with, like, condos and co-ops in New York. There's an underlying mortgage on the property itself. So one of the stipulations was that you could not sell for 15 years after their certificate of occupancy was issued, and the one that
mm,
was issued was in 2008. So what happened was, if you were to buy the property, if you were to, let's say, buy a condo there, you couldn't sell you could sell at any time. But what would happen was 50% of the profits would go back to the state,
oh
right?
wow,
So there were actually some sales where someone had bought homes for like 200, like with some of the condos for 200,000, and then sold it for like 450. And so they made 150,000, I mean, or $250,000 of profit, but they had to surrender $125,000 back to the state in order to do something called a recapture tax. Me, so I was like, look, I'm so close to the end, because I was moving to Georgia. I met my wife, and then we were gonna move down here anyway. So I was like, I did the cost calculation in my head, and I was just like, is it really worth selling? Because
Yeah.
if I sold it, then I have to pay half of it. So this year in January is when that program ends. So now if I sell it, I get to keep all of the profit without having to pay any of it back to the state.
Mm.
The state. And the thing is, though, the condo that I got, oh, dude, let me tell you, it's a penthouse apartment in New York City. So it's pretty legit. It's got a 400 square foot terrace overlooking the city. So I don't know if I've ever showed it to you. Like one of these days before I sell it, you should probably
You'll
come
have
by
to.
and see it.
Well, yeah, I've been
it's
meaning
nice.
to. I was supposed to come up because I knew you were going back and forth to New York, and now you've kind of just been working for Georgia, which I think is better for you personally. I don't want to see you having to travel so frequently, but I was really hoping over the summer I'd be able to go up to New York and meet up with you, Ahmed, and a few of those other friends. And luckily, we're doing that in October. In a couple of weeks, actually, 2 weekends. We're going to Vegas, but I think one of the things that I wanted to do was, have you guys show me around New York. I don't mean like carry me around, but I mean just meet up and get a drink or something like that and see what's going on. But yeah, that's great. I'm curious why if it's such a sweet place. I mean, I guess you don't want to deal with the headache, and you have your plan associated with buying the McMansion with the wife, and I mean that happy wife, happy life, right? So
no, it's just it really does come down to it just comes down to like not having to deal with the maintenance of it. And also when you think about it, I could take that same money, put it into, and right now is a good time to have liquid capital, because I could take that liquidity and put it into a yielding asset. And instead of it costing me every month to own it, because I still have the mortgage, I still have the maintenance due on it, and I'm not utilizing it, instead to turn it into a cash flowing asset. And it's a relatively safer cash flowing asset too. So right now there's a lot of opportunity in the market that I want to capture. So
when you say cash flowing asset, do you mean like a stock, a bond? Do you mean CDs?
some REITs, some bonds, some BDCs? They're, like they said, the yields are really good. The businesses are strong. Some of the ones that I've spoken about before, like Crown Castle and American Tower, that pay really good dividends, fixed. Even if you just put them in, even if I just took that money and put it in treasuries and not have to pay any taxes on it, I could do a 10-year treasury and make a 5% return on, let's say, a $300,000 thing. So that's like 15 grand a year tax free that I would be getting. Divide that up by month. That's $1,200 a month without any effort. So right now my negative column every month goes $1,800 towards a property that I'm not using. Instead, that would end up turning into a $1,200 plus. So not only am I saving money on spending, I'm actually gaining money on the
it's that'll be a good swing for you. I think the market has changed, right? I mean, while we get to complain about what's going on with CPI and interest rates rising, I mean, that also has a positive effect for people that do have cash, right? 2 years ago, if we were having the same conversation, it was like, well, shit, you got to invest it, right? But you don't have to anymore. And especially if if you're in Kris's situation here, it's like, honestly, if you just have some cash and you want to guarantee that it's there in the next 2 years, it's okay to lose out on the upside opportunity if you can guarantee that you're not going to lose money by putting it in a personal savings account.
Dude, a 2-year treasury. You could just do a 2-year treasury.
Or the problem with the savings account, which I was talking to somebody about this at work the other day, is like if the Fed decides to cut rates, that rate for the personal savings account is also going to get cut. Versus right now, if you can guarantee 2 years is when you want to buy, then buy a 2-year treasury or buy a year-long treasury and lock that shit in. And you might actually, like, if you buy a 2-year and you want to sell it early and they do cut rates, and you could sell that on the open market and actually make a little bit of a premium by selling it a little bit early.
Yeah.
If they do cut rates a little bit, but that might be getting into
take a look at this
with bonds.
This is the view from my apartment in the city. Hold on 1 second. So right here.
That's nice, man.
It's in Williamsburg. That's my terrace, outdoor terrace. And that's actually the city. That's the hospital I used to work for. But that's like Manhattan right there.
That's cool.
Yeah.
Shit, man. Yeah, I'm surprised that, I mean, makes sense. I mean, places like that always having an outside terrace, that's what I want. I just want a little spot. The problem that I have, Kris, is I've been living in
Mhm.
apartments where I don't have my own grill. And like I would love
Mhm.
to just come home, grab a
Yeah.
steak, grab some chicken or chicken wings or whatever, toss them on the
Mhm.
grill, walk away for 10 minutes, come back. 10 minutes is, I'm just throwing numbers out there. I'm just talking. But
Yeah.
you know what I mean? Like just having that ability to have your own fucking grill. Like right now, I've been
Mhm.
having to use community grills for 10 years. And it's like, I just want to have a smoker. Like I want to make some brisket. I want to make some pulled pork. Like what,
Yeah.
why can't I, like, I guess they're afraid I'm going to burn down the house or burn down the
Mhm.
entire apartment building, which I get from a liability perspective and a city code perspective, but it'll finally be
Yeah.
nice to be able to focus a little bit more on grilling and stuff like that.
Yeah. Everyone's got that happy place that they need to basically have it. Dude, I can tell you, my wife, I'm first like when she first met me, that's like the apartment. The apartment really did it in for me. I really had like the sweetest bachelor pad among all my friends. Whenever they came to hang out and stuff, it was just like, oh, Chris's place is just on another level. Let me show you another picture real quick.
Yeah, I'm
This
curious.
is a little bit. This is me when I was a little younger. So I played. We had beer pong on the
Oh,
terrace. Let me see some Facebook pics. Man, these are some old pics,
yeah.
dude.
The no
Good times.
picks.
This is when my cousin came over from the UK. Yeah, good times, man. Good times.
That's awesome.
Yeah.
Yeah, glad that you got to utilize it. That's pretty cool. Yeah, I'm pretty jealous. That's a pretty sick spot. My place right here is pretty good. I don't own it though. That's the problem. If I owned it, they were to the block north. They originally were gonna buy, before the pandemic, they're originally gonna buy that lot. And actually, they did buy the lot, and they were gonna make condos there, and it was gonna be half hotel, half condos, and then on the block north of that, they're gonna make like a little town center where people can put restaurants and people can hang
Mhm.
out, walk around, and that's kind of a lot of people are doing that here in Texas, and I'm sure a lot of other places across the US are doing that as well, where it's like you almost build an entire development and kind of like have its own little group of businesses together. And so I was going to buy a condo there starting at like 250 grand. And then I think that the place that owned my apartment building, I don't know if they just wanted to get out or what, but
Mhm.
unfortunately, by the time I was actually going to buy a condo, they had already sold and they said no, we're not going forward with it. They gave everybody their deposits back and stuff like that, which I was pretty upset about because you've seen it. I mean, I have pretty good view of the city of Houston from my yard. Well, I guess my
Yeah.
balcony. Um, and so if I can get something similar to that, either Airbnb it or just have a good piece of real estate that's going to be near downtown, right next to a rail line. The rail line can either go downtown or the rail line can go to the medical district, which we have some of the best medical districts in the world in Houston. So it's like you kind of can't beat it. Like you're literally right across from the street. You just literally walk across the street. You're on the rail line. You can go up or to the north or to the south for the hospitals. And so I thought it was kind of a no brainer, especially if you found like a travel nurse or something to rent it out. But some
Yeah.
people were piping up about Pepsi, and you're not really like a dividend specific kind of guy, are you? You're more of like a dividend as a byproduct kind of guy, right?
Yeah. Yeah. For me, I think the dividends are so the way that I interpret dividends is that I used to be the guy back in the day who's like, "Oh my god, the dividend yield is so good. Let me buy
Yeah.
it. That means that that's like an income." And so it was like, "Oh, that's nice." And that did okay, but it didn't like generate a lot of return.
Right.
And I saw that the people who did capital appreciation, they ended up getting way more in total return, especially when you factor in taxes and everything else, right? So the thing that I ended up discovering was selling to the people chasing the yields. That's where the real money is. So what happens is there are times where companies will get oversold and their dividends will look super juicy, right? And so the way that you want to structure it is that when that company improves, that dividend yield will go down, but that also means that there'll be capital appreciation. So right now, if you look at the REITs, so many REITs are yielding double-digit returns, it makes you ask, like, wait a second, what's going to happen to their cash flow? So the thing is, once interest rates start to come down, people are going to be looking for that yield. Everyone's going to be yield chasing. Right now, everyone is satisfied with the treasury yield of 5.5%. So everyone's like, oh, that's fine. I don't need to go into a REIT that's paying an 8% or 9% dividend. That's risky. So they're selling their REITs, and instead they're buying the treasuries, because the treasuries have a tax-free benefit to it too. But once the treasuries go away, if let's say tomorrow they start coming down to like 2%, people are going to say, I'm not holding a 2% treasury that's basically yielding the same thing as a inflation. They're going to be chasing yield. And what are they going to be doing if they're chasing yield? They're going to be bidding up assets that pay high levels of dividends, that are relatively safe based on repeatable cash flows. And that's when you'll see huge amounts of asset appreciation. So, I'm basically banking on that.
Yeah, I think I used to be in the same boat as you. Like, I used to be all about the yield, and I talked a little bit about this yesterday about how I realized the opportunity cost of investing in stuff like that. Like Altria Group, for example, this is the past 5 years, and the stock hasn't really gone anywhere, but yet it's paying a decent dividend yield. So I think it all just depends on where you are in your game, right? Like, are you a retiree where you need the income? That might make a better sense. But to be fair, honestly, as well, like if you invest in something like the S&P 500, it might go down 20% a year, but there's years that it goes up 30%. And all if you're doing is just trimming off the top, then you should be okay. So I think some people they get too caught up a little bit in investing in companies that just are too much about dividends and not much about reinvesting themselves. Pepsi, I think, is a little bit different of a boat. They haven't been the best capital appreciation company, but I think it's a good place to store capital, because it's going to keep up with inflation in terms of what they're selling and stuff of the like. And I actually have a couple hundred shares of this that I picked up at a decent price. I swung traded. I forget where and when, but to the point where I'm like thinking about continuing to sell it to just put it in the S&P, because my thought process is the following. It goes back to kind of what you said. Pepsi, great dividend, probably yields 3.5% at this point. Let me scroll down and double check. 2.9%. So it yields 2.9. Let's just call it 3%. But if I were to put it in, say, SPY, like, I could probably say with good certainty between now and 2030, 2032, the SPY is going to double in value. What I can't say for certain is that Pepsi will double in value. Pepsi is currently a $217 billion company. Do I see Pepsi trading at $450 billion? I don't know. That's pretty tough, right? And I don't think that they do as much buybacks as they probably should. They focus a lot more on the dividends and reinvesting back into the business. But at the same time, I don't think that it's going to be something that will double in value. So if that's the case, it's like, would I'd rather sacrifice, let's just say 1.5% yield, because in the S&P, you're still going to get a 1.5% yield on whatever you invest in. You're sacrificing half the yield, but you're most likely in the next 5 to 10 years going to outperform this probably by 50%. And so, and it's probably going to be a lot less volatile as well. So it's, it's a catch-22, but very much what, like you said, like, are some of these companies getting hit based off the fact that people are selling them to get into more safe investments, like just a savings account, which is actually yielding something, versus when it, 5 years ago, it wasn't really yielding anything. So in order to get any sort of drip or yield, you needed to invest in an Altria Group. You needed to invest in a Pepsi, which I think artificially inflated some of these prices. And so now I think you're going to see a normalization of, if we go back to a normal yield world where companies like this, like Pepsi, were trading at low 2% sort of yields, I think it would be probably normal for them to go back to a 2.75 to 3.25% yield comparatively to where they were, because they're not going to get bid up as much. And you're going to have to take on that risk associated with owning the actual equity itself. So it's an interesting kind of world where, and I think that that's part of the reason why price to earnings ratios were inflated a bit. Was, hey, everybody was investing in the stock market versus bonds because bonds weren't yielding anything, and the only thing that was propping up the bond market was the Fed. So you kind of have this renormalization of all these different business investments or asset classes that over the past, say, I guess since 2008, 2009 until I guess you could say 2022 have all kind of been under one sort of regime, which is being inflated artificially by the Fed.
Yeah.
So that normalization, I think, is what we're going to end up seeing.
So this is the thing that tends to scare the shit out of people, like this chart right here. If you look at the S&P 500 in terms of valuations, it's at a moderately, like, I wouldn't say overpriced, because if you looked historically, it's pretty much stayed like relatively flat, like around here. So this is the S&P 500. The problem that you run into is that when you take into consideration the multiples versus the current risk-free return of the treasuries, a lot of people feel that this is kind of high, like on the higher side of the valuation curve. But in my opinion, it kind of just depends on which sector, right? I think there's still some sectors out there that are, overextended, but then there's some that are like undervalued. And also, you look at that on a company basis as well. There's certain companies that are growing faster, and yet they're not necessarily, their PEs are haven't caught up to where there should be. Like I look at the two big companies that come to mind is like Microsoft, Apple versus Google and Amazon, right? So Google is actually doing more in terms of growth right now. They're on the right path. They're growing their earnings per share. They're doing these massive buybacks. So they're on a trajectory to be much higher. Microsoft, because of a lot of the hype around ChatGPT and everything, has run up so much that now they're in more like, hey, we're in not value. We're in like an overvaluation period, right? Versus Google, who's like catching up to these guys. So it's almost like this is a stock pickers market. Like for the last 5 years, we haven't had a stock pickers market. We've had a pretty much just buy the S&P and call it a day market. Now you're actually going to have to do some math. You're going to have to actually go in and say, okay, which businesses are actually improving their margins? Which ones are actually, releasing products at scale that resonate with consumers? And that is where I think, we can actually outperform the market. I don't think it's impossible to outperform it anymore. Here's a question. This is something that's been on my mind. Have you, over the course of how many years you've been investing? 10 years
10,
roughly?
yeah.
Have you beat the market returns, or are you underperforming the market over the last 10 years?
Over the last 10 years as a whole, I would say I definitely underperformed, which is why the last 4 or 5 years have been where I transitioned more towards a long-term growth-minded investor. Because initially, when I was looking, I was just like, people would ask me like, "Oh, but are you are you beating the market?" I was like, "I don't care about the market. I care about how many dividends I'm getting." And it's like, but at the end of the day, I was like, I was a 25-year-old kid at that point, or like 26, 7-year-old kid. I didn't need the dividends at that point. And so, had they asked me, it's like, I get it. Like if you're a retiree and you're sitting there and you're just living off of your portfolio and you're looking to just make sure you don't lose money and hand it down to a next generation or something like that, and you've made all the money that you need and you have a beautiful home and grandkids and the family and the dogs and whatever you want as your dream, that you don't really care about growing your portfolio much anymore, then that's where you're just like, I just need the dividends so I could keep food on the table and go on a trip every once in a while with the missus and continue to live out my dream. But I realized that there was a huge discrepancy about, I guess, and to be fair, I think a lot of people get fed this dream. Dividends are the only way. There's a person in here, in the chat saying that dividends are the only way. It's the only true passive income. And while they might have an inkling with that and a potential agreement, I feel like that they're going to trace yield like a lot of dividend investors. And to be frank, a lot of options traders, when they first start, also chase, because you can visualize very simply what the outcome is going to be. You could say, I'm going to put $100,000 into this. I'm going to make $10,000 a year, and boom, wham bam. And if I put in, say, 500,000, I'm going to make $50,000 a year and I'm done. Not recognizing the instability of that, not recognizing that they're sacrificing for short-term gain, the long-term potential growth. And same thing with options traders. They might, unfortunately sell covered calls basically at the money or just out of the money because they see that they're going to get a 2% return. But then at the same time, and I've experienced this as well. So I'm talking shit about myself, not just other folks, but just the beginning, and you're learning, you're getting that experience. You sell something, for example, my first covered call experience was selling, I think it was Square back in like 2014 or 2015. Square came onto the market. It was selling for $10 or $20 or something like that. And I was just like, I was looking at covered calls. I had 100 shares of it. I thought I was king shit. I had like $200 or whatever. And I think it was like a covered call selling at 40 in like 6 months or a year. By the time that covered call got called away, the stock was trading at like 80 to $100. So like, cool. I locked in 100% return, and I locked in the fact that I made like $2 a share or something like that. So my like break even was $42, but my opportunity cost was, so like you lose the forest through the trees sometimes. And if you don't know what you're doing, you're going to get burned. Now that could have been an unfortunate event, and it's too far long ago when I was still so uneducated about the market that I don't know, that might've been a good plan. And it, might've just been a freak accident, but I still see the same thing today where people are like, hey, I have Pepsi. I own the shares at 165. I'm going to sell them at 166 covered calls. And then it goes to 190 because the price just starts running on them. And they're like, oh shit. And they're buying the covered calls back for a $2,000 loss. And next thing you know, the stock drops back down to $165. And now they just pocketed a $2,000 loss for nothing when they could have just waited or sold it at a more appropriate price. And so it's just those little ebbs and flows about understanding the market where you're like, you learn over time. So now I've come to the conclusion, underperforming the market over the past 10 years, likely, to move something more like hey, I've accumulated enough wealth. I've saved so much at this point that I should probably have the majority of my wealth just following the market in the S&P. And then, like you said, choose the companies where I think the potential outsized reward is, I guess, appropriate for the amount of risk that I'm taking on. So, for example, there's companies out there, like SoFi is one of them, where I think the competition's too high. The risk is still kind of there. If they get to a point where they're at decent profitability, it might be a place where I take more of a position in it. Yeah. Rocket Lab as well. I think I have like $20,000 in Rocket Lab. If that gets to a point in a year's time where it mitigates some of those risks and checks off some of those things and mitigates them, it could be a $50,000, $60,000 position that I'm willing to add into, right? Yeah. And same thing with Palantir. Palantir started off as a $10,000 position for me. And as I recognized and read the balance sheet, and I was like, okay, these guys are actually adding money even they weren't profitable. I felt more comfortable because I saw that the actual cash flow was adding cash to the balance sheet every quarter. And so I was like, I know I'm not going to hemorrhage cash. My whatever I put into it's not going to go to zero. But I was like, you start hitting these points where then it gets more about understanding risk mitigation rather than just hoping and buying a stock and hoping it goes up. It goes to, what are you putting onto the market? What are the risks associated with it? And are you willing to accept those risks if they show up? Now, we always think we know more than we do, and risk can kind of come out of nowhere and blindside you. But like you said, if you're diligent, you put in the time and effort, Google's a good play. That's why when it dropped down to $80 last year, I was buying as much as I could. And same thing with Amazon. I was like, I literally was saying to myself, I was like, I'm screaming at myself buying this because it could go down to 70, could go down to 60. But I was like, I know for a fact in 5 years' time, I look back at this and I'm going to be parading around that I bought it at $80.
Yeah. Same thing with me and Meta. Like Meta was just so easy of a call for me. I was on the Freelancer Finance Discord every day for like a month, just posting DD. I was just like, look, everyone's missing this. Take a look. TikTok's not killing them. Take a look. And so that was a good thing. So sometimes when the markets are oversold, it's one of those things that's just right now. I think a lot of REITs are oversold, so I'm like so excited. Like they're my wife the other day, I had to borrow money from my wife because I over what I did was I was supposed to be getting some money dropped into my account, and it didn't come through right away because there was like a hold on it. But then I was like, "Hey, babe, I think I just went negative on my checking," which never happens because I usually am like the one lecturing her, like, "You should be keeping some money in your blah blah blah." But dude, I've been so like excited about this market that I've fully invested. I'm like, there's just such outsized opportunities right now. If I don't take it, I will regret it. And like I apologized to the wife. I was like, look, just put some money in my account. So she did. And so now I have enough to hold me over for a couple of weeks and until the other money starts dropping. Because I'm also like maximizing my contributions to my 403b or slash 401k right now. Because like I think in the next couple of years, I'm going to leave my job. And when I leave, I want to make sure that it's all there stacked so that this way I can use that money, convert it to a self-directed like IRA and just invest it how I like instead of having to like rely on their plans with that, whatever they have. So, yeah.
I have very interesting takes on that because I get scolded a lot by my peers by that. And my thought process is this, right? So I have probably about 70 to 80% of my money outside of a 401k. And so some of my friends are like, you're losing money to taxes and shit like that. And I'm like, to be honest, that's okay. I can use it to go buy a business. I could use it to go buy a house. I could use it.
Yeah.
But my thought process is the following. I don't recommend most people, especially if you're not saving a lot of money, to do what I do. I save an exorbitant amount of money. I save, and I also work at a decently paying job. So when I say 30 to 40% of my income, I'm talking about, anywhere between 40 to 60, $70,000 a year that I'm saving on an annualized basis. So, and I'm not saying that to throw this in the face. I'm just saying like, most likely you shouldn't do what I do. The reason why I do what I do with my 401k, I do a 7%. I get matched 7% by my company. So 14%. The reason why I only do the 14% is because I view that as money that I will never touch. And if I ever do make it to retirement at 65, I can guarantee that it's kind of there. Right. And that's kind of like, so anything that I make between now and then, and I plan on, I could see myself working at UDOC for the next 20 years if I find the right jobs within there that keep me motivated and stuff of the like. But I think that the way that things are kind of going with my portfolio and, how I want to continue to build with rental properties and stuff like that, I might leave early. I don't know. It'll be a problem that I have to experience 5-6 years down the road, maybe. But my thought process is like, if I have all my money outside, I could always bridge to that money if I need to.
Yeah.
And there's always like the rule of 72T as well, where you can take the money early if you distribute it evenly over time. But like, I don't want to have to go through all those hurdles of locking all my money in a 401k. It's like, what good is it if I have an $8 million 401k, but I have nothing in an individual brokerage account?
That's true. That's true.
And so I try to caution people. It's just like, look, if you're saving 15 to 20% a year, put 15% away. Because this might not be for everybody, but have you read The Shockingly Simple Math to Early Retirement by Mr. Money Mustache? Basically, and it's a different episode for sure, but in its kind of Spark Notes version, it's like basically if you assume a 5% return after inflation, all that sort of stuff, if you invest 10% of your money, you can retire within 50 years. If you invest 15%, you can retire within 40 something years. If you're obviously saving 90% of your money and you're only using 10% of your money that you get as sort of expenses, you can retire in 3 years, right? So like there's a spectrum of, with all these given returns on average, how quickly you retire, what have you. And so it's like the sweet spot is, and it shows like where most Americans are versus where most Indians are versus where most, like Australians and stuff are. So it's a pretty cool article, which I'll pull up in the future. But it's like, if you can it's all it is simple math is like, figure out where you want to go, figure out what your expenses are probably going to be. And it's going to be wrong. Everything's going to be wrong, but at least you put a plan together. You could at least be halfway there, if not maybe more. And you could say, well, I'm saving about 30% of my income. So I'm going to work for 26 years, 25 years, 20 years, whatever. I forget what the exact number is. I think you're saving 30%. You can retire in 17 years or something like that. Yeah. And if that's the case, then you probably don't want to have all your money in a 401k, because if you're starting at 30 years old, you're saving 30% of your income, you're going to be able to retire at 47. You're kind of screwed, right? Unless you want to take on a 10% penalty. So you really have to think about those things. And people always preach about, always doing your 401k in the sense, because most people aren't saving 30% of their income. But if you are saving that, then you really have to start to think about how you structure and utilize a lot of these different tools to your benefit. So that way you're not artificially locking things away because of something you were told. A lot of times what you get told is in good health and good judgment and is constructive. But you have to recognize, just like the stock market and investing in the stock market, it's like, it might be right for somebody to invest in a certain company, a dividend stock, bonds, whatever, but it's not right for everybody to do those things. Yeah. Right. If there was one size fits all, everyone would be the trillionaires. Right. Yeah. But there's not. And people get caught up in, you should be a day trader. You should be this, you should be that. It's like, you really have to find the path that works best for you. And, all the different ways to go about it.
Luckily for me, like me and the wife both have good incomes. So we both do, well. And it ends up being that most of our disposable income right now, we can actually put towards, making sure that we're maximizing our retirement contributions and investing it pretty, a good amount of it into things that we like doing, but then also investing it privately. Like, so my portfolio is stacked, like real estate wise, we're stacked, retirement, we're stacked. So we're in a good place financially. Like, especially when we compare ourselves to like some of our friends who have so many expenses, like we're dinks. I don't know if you heard that term, like double income, no kids. We're eventually going to have kids, but when you consider just how much excess money that we have coming in compared to other people, it's nice to have that giant buffer of like peace of mind, and that we could channel into investing so that 5 years from now or 10 years from now, it's like, oh, we're good, so yeah.
Yeah. The double income, no kids definitely helps. And some people are saying it's easy to do when you have no kids. I get it, man. Yeah. And that's why I save as much as I can right now, because if I end up in a situation, trust me, I know that the day is coming where I'll end up having a Mrs. Money and she'll want to buy some $700,000 fucking house, and I'm going to be paying $4,000 or $5,000 a month in a mortgage, and she's going to want the new Hummer, and I'm going to be like, well, shit, there goes all my 30-40% of my investment income that I was saving, and I'm going to have to start, stop spending money on $100 bottles of bourbon or scotch rather, and go to bourbon, which is $30 to $40. Back to eating peanut butter and jelly sandwiches versus, steaks, all that sort of shit. So, yeah, I mean, I know that day will eventually likely come. And so that's why I'm taking advantage of it.
I think the best advice I could give to anyone would be, number one, you got to be super careful with who you end up marrying, because she'll take half, if not 75%. So she'll take your balls and half your net worth. So, that's the one thing you got to do a lot of DD on. Make sure you do a lot of due diligence on the chick that you're going to marry.
That's the thing. After a few dates, I always toss in the idea, like, how do you feel about signing a prenup? And there's always been one or two that will always just be like, are you effing kidding me? And I'm just like, well, I mean, and it depends, I mean, if we're both the kind of equivalent, but most of the time when I end up dating somebody, it's generally speaking, there's a pretty big discrepancy between, there's a lot of people out there that might look like they're wealthy and stuff of the like, but they're house poor, they're car poor, it's kind of cool when you see chicks roll up in like a Range Rover, like, oh, this chick, maybe she knows what she's doing, maybe she's a doctor, maybe, and you find out that they're blowing all their money
Terrible
on their
with
cars.
money.
Yeah. Or purses and stuff. Like, purses aren't that bad. If you're buying purses that are good quality, they hold their value, right? But some shit, man, just doesn't.
I still remember I was dating this girl who had this like fetish for Ferragamo. Like I remember like the first date we went on, all she would do was just telling me about like all the luxury shit that she owns. I'm like, hi. Like I was just sitting there and just listening. She's like, I really love Ferragamo. And I was just like, man, it's your first date. Like, what is this, like a pitch for Ferragamo or something? What's going on here? So I don't know. I think I made the right choice in picking the right partner. Like she's super supportive of everything that I'm doing outside of what is that thing called? Outside of just like working and everything else career wise. She's always supported a lot of the crazy shenanigans that I've always been part of. What's everyone's favorite REIT? So I would say right now, from a safety standpoint, Crown Castle is my favorite. SLG was my favorite when it was trading at $20 because the valuation was like, oh, it was too good. Valuations have kind of like come back a little bit. So remember, that's what happens. If the price of a stock goes down, that becomes your favorite because the total upside is much greater. And so if it comes back to trading at a higher range, there's other honeys in the market right now. So CCI, in my opinion, is a good honey to be in. So,
Yeah, I'm looking forward to the earnings call for SLG because it's going to like normalize now that some of their businesses are now only 49, 51% or whatever that they have. So I'm kind of curious to see how the funds from operation is going to kind of go forward from here on out. So I can kind of rebase, obviously they've limited some of the debt, right? So the net interest income, the net interest that they have to pay is down, but the funds from operations obviously are going to take a hit. So I'm kind of curious where they land and how that adjusts their price to funds from operation. I still think that they're vastly cheap. I think they should easily be trading in the 50s, but there's that. I recently sold Realty Income to buy the S&P and maybe some NextEra as well. I'm trying to remember, but so I did sell that. And I knew several years ago I'd eventually sell it. I knew that a landscape like this was coming, not necessarily the landscape for interest rates. I can survive something like that. What I can't survive is all the theft. What I can't survive is seeing literally stores that I know are owned by Realty Income around me being shut down and the property is literally sitting vacant. That I can't see. And I knew that was happening with e-pharmaceuticals coming in with Amazon and things of the like. A lot of the, you might not think it's a big deal if 6% of your tenants start to start fading underneath, but when it's 6% of your tenants like CVS and Walgreens and also Dollar General and also Walmart and also all these people are under attack right now. So to me, pretty scary. The one I sold WP Carey to actually buy SLG, which was well timed because I think I got 80 or something bucks for WP Carey. Maybe it was $85. And I used that to buy SLG. And obviously that's up 40% from here. When, I didn't get it as good of a price as you did, but I did get in the low 20s. My other stock other than SLG for REITs, I do have Fundrise. I do have a little bit of money in Cardone Capital, which pays me every month as well. But the thing that I have, why am I drawing a blank on, is Stag Industrial, which is a triple net industrial warehouse REIT. And so they'll look for warehouses that are outside of major cities. And Amazon has actually become one of their biggest clients, believe it or not, understandably, because Amazon's buying a shit ton of warehouse space. And so I was buying them back in 2014, 2015, when David Fieber, who actually started a website called Dividend Mantra, I think he eventually sold it, moved to Thailand. I think he still lives in Thailand, but he's now back on Twitter and back on social media making YouTube videos again. He does a really good job with it. But he introduced me to the stock. The reason why I was attracted to it initially, it was a monthly dividend pair. And it turned out to just be a good kind of company to be invested in. And so I've held on to that since 2015. I've only added to the position. I think I have 700 shares of that. It's paying me about $100 a month almost in dividends. So
Nice.
I need to reevaluate it though. Just looking at the maturity schedule, you and I talked about that the other day. It's been a while. Sometimes when you own some of these stocks, you kind of put them on a back burner and you don't pay attention to them. Now, when earnings seasons come around, I'm looking at Amazon. I'm looking at Google. I'm looking at the cool shit. But I'm not really thinking about the stuff that I've been invested in since 2015. And that could be room for danger because the landscape changes. Things can get hot and things can get cold. Luckily, I don't think e-commerce is going away. In fact, I think if you exclude, I forget what the number is, but it's like if you exclude, if you do all total e-commerce, I think it's like 14 or 15% of it. Sorry, if you include all commerce, 14 to 15% of it is done through e-commerce. And I think if you exclude certain sectors or certain purchases, I think it might have been food or something like that, about 26 or 27% is done through e-commerce. And so there's still running room where you have a lot of need for warehouses and that storage areas for places. And so I think that has good running room for it.
Yeah. My biggest problem right now, the one that I see as a really big value trap is like Realty Income. It's been a good company to be in for a long time, but take a look at this real quick. If you look at what their triple net leases are, like primarily focused in, that's the part that worries the shit out of me.
Yep. And that's why I was always like, knowing that in the medium term, I was always going to get out of it.
Yeah. So like right now, Dollar General is having issues with shrinkage, right? Where people are stealing a lot of stuff and they're pretty much located in areas where there's just a lot of crime. Dollar Tree and Family Dollar are in the same position, right? 7-Eleven is actually not bad. Walgreens is getting killed by the online pharmacy markets, and also once again theft happening, right? The other ones are fine. Like all of these are okay. LA Fitness is fine. Regal, what do you call it? Lowe's is having the same issue with the others, which is that they have a ton of shrinkage happening. Regal and AMC is like on it's, I don't know how it's going to survive, but their 1.3% of their leases is not good. Same thing with Regal. Movie theaters right now. I went to a couple of movie theaters, barely anyone there, dude. I think the movie theater business is going to have to contract significantly in order to make it worthwhile. So I think a lot of these triple net leases may not be there in the future. Walmart is fine. Tesco is fine. CVS Pharmacy is running into the same problems as Walgreens. So if you look at it, they do have issues around risks in terms of concentrations in certain industries. And the problem here is that, remember, most of their income is going to be generally they're going to make money on a marginal basis, right? So you have a certain margin above the core value that you're going to be able to extract and pay out to holders. But the minute that you have one asset or two assets that stop yielding, that means that now your total yield that you're going to be able to capture goes down significantly. So, let's look at the stock price. What's going on with that? Like over the last year.
I have it right here.
You do? Okay.
Oh, you got it. No, you got it.
Yeah.
Down to 50 bucks.
Yeah. So while the dividend looks juicy, it's like, 6% dividend over the long term. Look at Realty. They've done really well. I ask myself, I'm like, wait a second. So what have they been done in the last 5 years? So they've actually underperformed in the last 5 years. And even with this juicy yield, it doesn't look like a good value proposition. Like when you compare that to something like, let's say CCI, right? CCI's biggest problem is that they issued a lot of debt in order to finance a lot of capital, right? So right now they pay a 6.64% dividend, which is relatively the same as but they're but they're not having the same issues as always with regards to shrinkage and everything else. Their issue is they just have a lot of debt on the balance sheet, which they're going to have to restructure and everything else. But most of it is very well layered so that they don't have to deal with any real big debt maturities anytime soon. So they're actually able to grow their dividend as well. So if you look at like CCI's dividend, It's very well. Hold on, history. It's very well managed, and it's actually been growing every year. So right here, right now, you can see going back to almost 2013 when they first started, they went from 35 cents a quarter all the way to like 156 a quarter. The growth in dividend yield, I mean, the growth in dividends in the short term will take a small will take a small dip, but it's going to keep growing its dividend. So what's going to happen is a lot of people are eventually going to start yield chasing this company once it happens. So like I think Realty Income has a lot of problems, but these guys don't. I think once people wake up to the idea of 5G and like 5G is a theme that I really believe is going to be a big thing going into 2030, where there's just going to be so many more people on the 5G network and the spectrum. So many more devices are going to be on these spectrums, that it's just these guys own the ground underneath the industry, and that's where you want to be when it comes to a REIT, right?
Right.
There's a lot of good data center REITs too, by the way, that we should.
Yeah, I used to own CyrusOne. CyrusOne did really well for me. I think I bought that in 2014, 2015. And that was something that I think I rolled into WP Carey when that kind of seemed out of favor. And both of those I did relatively well on. I did like CyrusOne because I thought it was going to grow dividends way faster. But I think what ends up happening is like, you can catch some of these REITs, and this is a good example of what happened with you can catch some of these REITs when they're kind of in their prime, where they're growing dividends really well. They're not too big, so there's not a lot of inefficiencies. But I think you get to a point where, for example, with when I first started investing in in say 2015 or 16, I started like holding a position. I think they had like 1,500 properties. Now they're over like 4,500, 6,000 properties, but the stock price hasn't gone anywhere. And it's because they keep issuing so much stock, and the debt's kind of holding them down. So it's like you have so much inefficiency with owning some of these positions that it's tough. But meanwhile, if you think about what's happened since 2014 to now, cap rates have gone down. So a lot of the value of the companies and the assets that they own should be skyrocketing. So it doesn't make sense sometimes. So sometimes these REITs just get super bloated. And I think it's eventually like the treadmill of the debt kind of catching up with them. And that even gets exacerbated with what we're talking about right now. Somebody was asking specifically, I mentioned Cardone Capital. Yes, I do have Cardone Capital. I think I have like 15, 20 grand in there. I forget exactly how much I put. It pays me directly in my bank account every month. It's different, right? It's not like a REIT. You can't just buy and sell it. It's actually physical real estate. There's 4 apartment buildings that I have a percentage in Florida, 1 in Southwest Houston. And you get a K1 every single year that talks about how much that value of the asset is appreciated. And so it's different. It's not like you can see a share price every day, but you get money to your bank account, and it's pretty cool. Eventually they'll either refinance, sell it, and depending on what happens, I might use that money. It's grown substantially. So I invested in 2018. So pretty good time to buy real estate if you're looking at multifamily. And I think that 15 or 20 grand has grown by like 2.5 times. And so whatever it is now, it's probably in the $50,000 or so range. And I'm getting, not a lot of cash flow. I think it's like on my original investment, it's like 5 or 6% yield. Directly in my bank account. It goes up slowly every year. So I actually just checked. I actually got a small raise of like $2 or $3 every month, compared to last month. So it's different though. Like you can't just call up Uncle Grant and be like, hey, I want to sell. It's like you have to wait for them to refinance the loans or sell the properties. Otherwise, it's like owning real estate at that point, And then I also do Fundrise as well. And if anybody is curious, I have videos on my channel about that. I don't want to go too much into deep with that.
Yeah. Maybe we'll do an episode specifically on just income generating assets, or like REITs or BDCs, because I think a lot of people could benefit from that over the next 5 years. There's a lot of great opportunities in the market where a lot of these companies have been sold off and they pay a pretty good return. so you'll get the best of both worlds, which is number one, you'll get capital appreciation, but then you'll also get the REIT yield itself, and you'll be able to lock in that REIT yield. And as the company does better and they grow the business, you'll get higher and higher and higher dividends. So it's like almost like investing in a company, and then the company is growing, but it's also paying. That's what I love about like AMT and CCI. Like both of them are trading at like 5-year lows right now, and their business is not suffering at all. Like they're fine. Their business is good. People are still using their cell phones, and I think they're pretty insulated compared to a lot of other businesses and industries that might get disrupted. So we'll see.
Well, it's the same sort of idea that you had with SLG, right? Like SLG, they might have to sell some properties, but the funds from operations aren't going anywhere. Like these are premier A class properties. So it's almost the same. It's like 5G is not going anywhere. These towers aren't going anywhere.
And the other thing is the occupancy rates are starting to recover too. Like it's one of those things that you just have to look a little bit further into the future, and basically you'll see the recovery play that's happening. And the other thing is like sometimes things get really, really just too oversold. Where I think SLG at one point was trading at $1 billion, but they have like assets that are worth like $7-8 billion.
Yeah, it was like 7 or 8 at the time. Yeah.
I was like, wait a second, even if they sold this at like a 90% discount, it'll still pay all their shareholders back. And this is class A real estate in New York City. So It's like, okay.
Mm-hmm. It's like you're betting on one of the premier cities. And that's the thing. All these big, but it's still New York City. It's like even in the 80s when New York was down and out because of the crack epidemic and everything, all the gun violence, it's like it comes roaring back. You know what I mean? Like generally speaking, these cities always go through ebbs and flows of what's kind of going on. But once again, I always appreciate the amount of due diligence you put into these graphics that you always show up with, Kris. And if you guys haven't already, in the description, Kris has his Patreon down there. Be sure that you guys check that out because it's a well full of knowledge. And Kris talks about stocks like I would say most people do not, because most people don't put as much due diligence in as much as Kris does, and he's a well full of knowledge. He's a Patel, for God's sakes. So but I always appreciate it.
Yeah,
Kris,
that's the selling point. That's the selling point, right? The Patel.
The Patel piece, right? Always reach out to me or Kris if you have any questions. We're both available on Twitter as well.
Yeah.
And
thanks for joining. Thanks for joining. Make sure you guys like and subscribe to the channel.
Yeah, we got another member today, which I was pretty excited about. I don't know if that makes it 5 or 6, but either way, I think it makes it 6. So pretty cool to have 6 members now. The Money Gang, I think I called it. So it'll be cool to have that and continue to grow as long as your Patreon continues to grow as well.
Yep. Appreciate it.
See you guys next Tuesday.
Later, guys.
Cheers.
Bye.